Hello, good afternoon, everyone. Hello, good afternoon, everyone. Thanks for joining in. Hello, good afternoon, everyone. Apologies for the delay in commencement of the program. You're welcome to our quarterly webinar session. My name is Miracle Mbakwe. A happy new year to everyone, and thank you for making our time to join us once again in this enlightening program. So with me here, we have our Group Managing Director, Mr. Johnson Chukwu, who will take us through the quarterly performance and also the yearly performance of the Nigerian economy and the global economy at large. It promises to be an insightful time, and we can't wait to have you join us. So thank you once again, and you have the floor. Sir, please, you may proceed.
Thank you, Miracle, and good afternoon, everyone, and Happy New Year. Like Miracle said, my name is Johnson Chukwu. So I'll be speaking with us on our review of last year's macroeconomic environment, the global macroeconomic environment, Nigeria-specific macroeconomic conditions, factors that drove the economic performance of the country, and then we take a glance, or we take a peep into what we think will be the economic performance in 2024. Before I proceed, I want to thank you, those of you who have been faithful, like we say in Christendom, in joining us at each of these quarter performances. In the course of our conversation, I'm going to speak on the macroeconomic outlook, and I also speak on the macro outlook. Then I will create a question section for what I may call the Main Street outlook. Because of the broadness of the Main Street, I may not be able to speak on all the Main Street areas. What I mean is the people who are on the streets, what will happen in the construction industry, what will happen to the tailoring or fashion industry, what will happen to the telecommunication industry. So I may not be able to speak entirely on that, but probably we'll speak on some of those sectors. And then I will take questions that will help us dive in or dive deep into sectors then we will not have spoken on. So I'm trying to share, I will try and share my presentation now. I wouldn't know if we can see the presentation. If anybody can just indicate they can see it.
We can see, sir. We can see it. We can see it.
Okay, good. So it will be like I said earlier. Okay, Olu Omole has raised his hand to indicate I can see it. Thank you, Olu. So like I said, I'll be speaking on Nigeria's economic outlook, performance in 2023, and what the future bodes for us as a people. I need to, okay, just a second, I might need to. So looking at Alabi, read one, I can see you raise your hand. So we'll take, if there are questions, if you're just to confirm that you can see the slide, fine, I feel you. But if they are to ask questions, we'll take the questions after the presentations. Thank you for those of you who have raised your hands. Well, this is just to give us a helicopter view of what we'll be discussing. The global GDP, is likely to grow at 2.4% this year, according to the World Bank. The World Bank is projecting that GDP will grow at 2.4%. This compares to 2.6%. It is projected that the world global GDP would have grown last year. Remember, we don't have the full year GDP performance for any country. So, but World Bank is projecting that the global GDP would have grown last year at 2.6%, down from a 3% it grew in 2022, and the 6.2% it grew in 2021. Remember that 2021 was a post-COVID era, so we saw a rebound from a global recession. So if you exclude the period, then you realize that the growth in 2024 will be lowest since 2009. If you exclude the recessionary period of 2020 when there was a global lockdown, you will agree with me that the GDP growth rate we are going to witness this year based on the World Bank projection, IMF World Bank projection, will be one of the lowest. Demand for crude has remained surprisingly robust, despite the challenges experienced in that sector. Obviously, because the OPEC and OPEC Plus had actually tried to maintain price stability by cutting down on production, but the volume of cuts that they recorded was not sufficient enough to change the direction of crude prices. Then, but interestingly, the geopolitical tensions we're having now, due to the Israel-Hamas war, has created additional nervousness in the oil market. You may be aware that yesterday, the Houthi militia in Yemen was able to hit a vessel in the Red Sea, and that created a momentary spike, what we call flash increase in the price of crude and all the byproducts of crude yesterday. But I think that has corrected, or had to some corrected. U.S. inflation has started being coming down. The Federal Reserve Bank at the last meeting maintained its monetary policy rate at 5.25 to 5.55%, which was a 22-year high, given the stability in that economy. It's expected that the Fed would no longer increase rates further, but although they have indicated that, the policymakers have indicated that if anything, there's a flare-up in inflation rates, they might still increase it. Otherwise, we're beginning to expect that the Federal Reserve Bank will begin to cut rates in the near future. There are several implications of what happened to the Federal Reserve Bank. If they keep rates up, then it makes U.S. instruments very attractive, and capital will flow to U.S. and then leave emerging economies like Nigeria and other countries. So we're all interested in what happens, the decisions that the Fed take in their meetings. Falling energy prices and end of COVID-19 pandemic restriction raised hopes of a quick rebound in China, but that rebound has not happened as much as people expected because of the issues around the property market. The Chinese economy is going through some difficulty as it relates to the property market. Then if you look at coming back home, you will see that Nigeria's GDP had grown in the first 9 months of last year at an average of 2.45%. This is principally, if you recognize the fact that the GDP grew at 2.31% in the first quarter of last year, 2.51% second quarter, and 2.54%. So if you take the average, you have a GDP growth rate about 2.45%. If you compare this to the budgeted growth rate of 3.75%, and the World Bank IMF forecast of 3%, you clearly agree that the economy has been underperforming. The slow growth, or what we call the fragile growth we are witnessing in the Nigerian economy, is largely attributed to challenges related to insecurity. And where we have to recognize that the challenge of insecurity, remember that agriculture accounts for about 29% of the GDP based on the Q3 GDP report. So an agriculture sector only grew by about 1.3% in the third quarter of last year, which implies that a part of the GDP grew at only 1.3%. And so then you can now understand why the GDP at best grew at 2.45% the first 9 months of last year. So one of the major challenges is we have to deal with the issue of insecurity, terrorism, low capital inflow, increasing capital flight. We're seeing some companies who have been here for a long time, who ordinarily should be called Nigerian companies now, leaving the country and without replacements. Then we are dealing with the issue of devaluation of local currency and intensified high rate or monetary policy rate, 18.75%. These are factors that have hobbled the economic performance of the country. However, in 2024, this current year, we expect reforms in the downstream sector, further reform in the downstream sector. Of course, we know it's expected that Dangote refinery would start operation anytime now. There are tax reforms ongoing. This is in tandem with the president's inaugural statements. There have been foreign exchange reforms. We saw on 14th of June, harmonization of exchange rates. And then there are also, and those reforms are likely going to continue. We've seen attempts by the central bank to ensure that they bridge the gap between the parallel market and official rate. These are some of the reforms we expect to drive this year's economic performance. And then added to that is the likely listing of the NNPC, possibly increase in crude oil production. And I use the word possibly increase in crude oil production, ability of the government to address the insecurity in most parts of the country. It's no longer, we used to talk about insecurity in the Niger Delta, but now we're dealing with insecurity across virtually all the geopolitical zones of the country. And then you have to deal with the issue of corruption, which is now a major cost to business in the country. The CBN governor actually unveiled his plan for the financial services sector at the bankers' dinner sometime in November last year. And that was included that he was hoping that he's going to drive a recapitalization of the banking industry. He's going to return the central bank to orthodox monetary policies. So he's going to do away with the unconventional monetary policy tool that the previous CBN governor was using. That the central bank will focus on inflation targeting and target interest rate reduction. They want to drive down inflation, and they want to ensure that there is stability in the foreign exchange market. However, ability of the central bank to achieve all these lofty objectives will depend largely on the fiscal alignment on its success to align with the fiscal authorities or fiscal policies and the president's support. Of course, some of this, the statement that the CBN governor have made, all depend entirely on the presidential support. For instance, if you talk of recapitalization of the banks or capitalization of the banks, it requires executive support. Issues around fighting inflation will depend largely on ability of the monetary authorities to align, the fiscal authority to align with monetary authorities' direction. That is, the fiscal authority has to cut down on ways and means funding of the budget deficit. Otherwise, the liquidity surplus that comes from ways and means funding will continue to impact negatively on the ability of the central bank to maintain exchange rate stability as well as reduce inflation and lower interest rates. Nigeria's foreign exchange policy has gone through very dramatic changes in the past 6 to 7 months. We've seen elimination of multiple exchange rates. Yes, there are still largely 2 exchange rates. Remember, previously we used to have the retail window, we had a wholesale window, we had several windows that act as a conduit for political patronage or economic patronage, or whatever you prefer. We've seen that eliminated. We now have largely 2 rates. You have the parallel market rate, you have the Nigerian autonomous foreign exchange market. And then probably the Nigerian autonomous foreign exchange market also mirrors the Nigerian interbank foreign exchange market rate. But transactions are done at the Nigerian official autonomous foreign exchange market rates. And we're now dealing with situations where the banks are supposed to determine rates. There's a floating exchange rate. We've seen movements in even the NAFEM's or foreign official rates move to as high as 1,099 naira and close the year at 907 naira. We are seeing the 2-way quotes, but the challenge we still have is that the market still lacks liquidity. And therefore, the central bank is still the key market maker. And without market liquidity, some of these noble intentions of the central bank on liberalizing the FX market may not easily be achieved. On the positive, the Nigerian Stock Exchange gained 45.9%. So many people who have joined here, I'm sure, have made money last year. That increase was driven by policy changes. We saw market rally at different intervals when one, the subsidy was removed, and then secondly, when the exchange rate was harmonized. So these factors are clearly factors that drove market performance last year. So we saw a market that gained over almost 46% last year. Even as we speak today, as at the close of trade yesterday, the market had gained as high as 17.65%, just the first few trading days of the year. 17.65% market gain. The outlook for 2024, our own projection, the outlook for 2024 is still largely uncertain. There's likely going to be an increase in interest rates to moderate the inflationary pressures. At the global level, we expect that in as much as the US and some of the Western countries may begin to moderate their interest rates, but then you still have the geopolitical tensions around the Middle East. You still have the ongoing war, which, according to the Ukrainian president, said that Russia wants to normalize the war, so it becomes a continuous war that will last for a long time. At the local scene, the outlook for interest rates, inflation rates, and exchange rates are southwards or negative. So, and that would mean that in as much as the economy would grow at a rate higher than the previous year's growth rate, we might still have to deal with macroeconomic challenges associated with high interest rates, depreciating local currency, and high inflation rates. But we'll speak on that when we get to that outlook session. So this is basically so let's review the global economy, take a deeper dive at the global economy. The global economy activity sustained a slowing trend. Sorry, that's a slowing trend. The global economy sustained a slowing trend. I just need to correct that and project it again. Due to tight monetary policies, constrained financial conditions, and sluggish global trade growth, global output is projected to grow at 2.4% in 2024, which I said earlier is going to be one of the lowest since 2009, other than a year of the recession in 2020, which was then induced by COVID. However, emerging market and developing economies are going to face some higher level of vulnerability. We know that some emerging economies have actually defaulted on their Eurobond, including Ghana and Ethiopia. So which also means that the emerging economies and developing countries' ability to access financial support from the global economic, financial system will be highly constrained, either in terms of lack of availability or higher rates. So, and like I said earlier, in as much as the US Federal Reserve Bank may not increase rates immediately, some of them still have concerns that if there's any flare-up, they will see increased rates. So at 5.25 to 5.5%, a US Treasury instrument is very attractive to any investor. So you can see capital flowing to US instead of remaining in emerging markets and developing economies. I did mention earlier that we've seen the challenge of a war between Russia, in as much as the effect of the war between Russia and Ukraine seem to be ebbing. We now saw a flare-up between Israel and Hamas. And the challenge with that is that the way the war is taking place is a major shipping corridor for oil. In that axis, you have the Red Sea and you have the Suez Canal. and both are being threatened. Of course, we know that the US and British forces had actually bombed Houthi rebels, militia. The Houthi militia has vowed that they will hit any vessel that's either Israel flagged or heading to Israel or owned by people of Israel or Israelis. And they have made good that threat by hitting a vessel that was in that corridor on Tuesday. And that led to a flash increase in prices yesterday. But the basic thing is that this war doesn't seem to be going away, and they could, if care is not taken, spill over beyond the limited territories affected. Global headline inflation is supposed to, we've seen a decrease in global headline inflation. We also saw that was driven largely by reduction in food inflation. Of course, we know one of the reasons why we had a spike in food inflation in 2022 and 2023 was because, particularly 2022, was because of constraint in exporting wheat from Ukraine and Russia, who are the largest producers of wheat in the world. But the issues around the Black Sea has, to some extent, moderated, and we're beginning to see normalization in food exports. And that's why if you go to most Western countries, we've seen a decline in food prices. But that's contrary to what we have in the country today, because of the challenges we have with insecurity in major food base of the country, we are dealing with a food inflation of about 3%, which is a factor driving up inflation, which got to 28.92% in December. Global trade also slowed down because of part of the challenges we have, we're dealing with. We've seen, and that also is one of the reasons why we saw a major, not a major slowdown, but a suboptimal growth in China. Remember that the Chinese economy is largely export-oriented, although they're now trying to pivot the economy back to local consumption. So, having looked at the global economy, let's look at deeply into our own local economy. 2023 marked a very impactful year in the Nigerian economy. Several things actually affected the economy, one of which was the CBN cash crunch, and then the general election. We need to also recognize that in that same year, last year, we had to deal with concerns around high inflation rate, rising unemployment rate, public debt. Forget about the 4.1% the Nigerian Bureau of Statistics said the inflation is. Unemployment is. It's difficult to live with that, a 4.1% unemployment rate in the country. So we're also witnessing a rising debt. Public debt has got to about 87 trillion naira. Currency depreciation and declining foreign exchange reserve. These are factors that we are central to the economic decisions that investors took last year, and they were also central to Nigeria's economic performance. One was starting from, which was a spillover from the previous year. Before the end of 2022, the central bank came up with a cashless policy, or whatever they called it, that led to a major cash crunch from late 2022 that spilled up to the election period. And then you had the general election that took away business operators' attention from economic activities to political activities. And then you had to do with that. The government came in, the government devalued the currency. So the devaluation of the currency led to an immediate, first the government removed the subsidy and petroleum products, which led to immediate spike in fuel prices and transport costs. Subsequently, within the next 1 month, in less than 1 month, the government devalued the currency or harmonized the exchange rate. And these factors had immediate impact on inflation. We've seen increasing rate of unemployment. We've also seen exit of foreign businesses that were previously in the country. The government has continued to borrow from the central bank. And last year alone, we first saw a 22.7% government the federal government request, and the 7.3% to securitize ways and means funding. So in effect, within the past 1 year, we have securitized over 31 trillion naira, which was ways and means funding. All these things added up to the national debt. In fact, the 7.3 trillion is not even part of the 87 trillion we have today. By the time you add that, you'll be talking about 95 trillion naira as national debt. We had mentioned the GDP growth rate, which I said has been what we call fragile. First 9 months of this year, we expect we saw a 2.45% growth, starting from a 2.31% in the first quarter of the year, 2.51% in the second quarter, and 2.54% in the fourth quarter of last year. So averaging about 2.45%. The federal government had budgeted that the GDP grew about 3.75% in 2023, and IMF had projected that the GDP will grow about 2.9% in 2023. These projections don't seem to have been achieved. And like I said earlier, some of the challenges that hobbled growth were issue of insecurity, which severely affected the agricultural sector, despite a lot of intervention funds that went to the agricultural sector. That sector only grew by 1.3% in Q3 2023. So this is just to show you what I was saying. If you look at the left side of the graph, you will see that our GDP growth rate has remained largely weak. In fact, the average GDP growth in the past 8 years is just about 2%. Because if you look at the past 2 years, 8 years, you see 2015, it had 2.79%, which was a major drop from about 6.22% it was in 2014. And then in 2016, you had a recession with a contraction of 1.58%. And then the following year, you had a growth of only 0.82%. And 1.9% in 2018, 2.27% in 2019, decline or contraction of 1.92% 2020, and then a growth of 3.4% in 2021 and 3.1% in 2022. The outgoing year, we are likely going to end up with a region of in the region of 2.5% for 2023. And this is on the right side of the graph of the slide is at the quarterly GDP growth rate for the past 11 quarters. So this was what I was referring to, that agriculture accounts for about 29% of your GDP, and ICT currently accounts for 16% of your GDP, and trade accounts for 19% of your GDP. What is recognizing here is that ICT used to be an inconsequential part of our economy, but today there is the second largest contributor to the GDP, which also indicates that with the right policies, we could actually grow some of the sectors that are laggards today. The manufacturing sector is only 8.4% of the GDP, but unfortunately, the manufacturing sector grew by only 0.48%. This is a sector that should be preparing employment. And then you have the mining and quarry, which is where the oil and gas sector is, contracted by 1.96%. So if you look at the sectors that account for about 75% of your GDP, the only one that grew materially was the ICT sector that grew about 7%, 6.69% or 6.7%. So this is basically what I was speaking about, that the sector that, if you look at your mining sector, which is about 5.64% of GDP, it contracted at 1.96%. If you look at the manufacturing sector, I mentioned 8.42%, but grew by only 0.4%. And then the other big hitters, which are trade and agriculture, grew at 1.5% and 1.3%, respectively. So this is just to show you the fastest growing sectors of the economy. You can see clearly the finance sector, which accounts for If you look at the financial and insurance sector, which account for about 4% of your GDP, grew by about 28%. So, and then you have other sectors which may not be, the water supply and waste management is not a major contributor to the GDP, but grew by about 11.9%. So these are just to show you our kind of projections or forecasts for the economy in the current year. The federal government in the medium-term expenditure framework had said that the economy will grow at 3.76% in 2024, 4.22% in 2025, and 4.78% in 2026. Our projection is that growth might be a tough call of 3.76%. We believe that the GDP will grow slightly above the growth rate of about 2.5% this year, 2.5% this year. But we think it will not be able to achieve the 3.76%. IMF had projected that it will grow at, well, the economy will grow about 3.0%. But our projection is to be between the range of 2.5% and 2.7%. So we think the sector that will drive that growth will be the construction sector. And what I talk about construction sector, a lot of the state government and the federal government, because of the harmonization exchange, are getting a lot much higher allocation by from FAC, Federation account, and we expect that to see improvement in construction activities largely coming from government contracts. We expect the ICT to continue to grow. We expect the finance services industry to continue to grow. They are beneficiaries of some of the monetary policy directions of the central bank. We expect a major improvement in the downstream oil and gas sector because of the Dangote River that will come on stream. So because once you see the refinery coming up, that will be counted as a major economic activity, and we believe that should see a spike in the downstream oil and gas sector. Remember that Port Harcourt refinery is also supposed to come on stream. So, like I said, so it's actually about the same side. This is actually the appropriate slide. So, if you look at our outlook for inflation, government had projected that the inflation rate will get to 21% this year in the budget, 2024 budget. Our take is that the best we should expect is 20%. We believe that the inflation should moderate below what it is today, principally because of the base effect. And then the fact that some of the factors that drove inflation in 2023 will no longer be present this year. Chief among them was harmonization of exchange rate and a major shift in the pricing of refined petroleum products. So those things we don't expect to repeat. In as much as we expect that government will be compelled to increase the price of fuel along the line in the current fiscal year, because as we see government continuing pushing to ensure that they maintain some of the policy trust they have come up with, which includes that there shouldn't be subsidy on refined petroleum products. So if that happens, we should see the impact on inflation, but we don't think the impact or the shift in price will be as material as what we witnessed. It's from 198,200 to about 600 now. So we think the inflation rate will moderate. So our best, our moderate expectation is that it will moderate to 27%. Then in terms of GDP growth rate, we expect somewhere between 2.415 and 3%. The best case of 3.25% is what we may call the optimistic case. On the exchange rate, we think the best we should see in appreciation of the parallel market rate or harmonization around 1,000 naira to $1. But we think also that's the most optimistic option. We think the moderate option or should of 1,300 naira to $1 should be the most likely outcome. But the worst case scenario, we expect naira could depreciate as high as 1,500. Depending on all this, will depend on what happens to crude oil production and crude oil prices. I had mentioned earlier that our take is that the construction industry should benefit from the budgetary allocations at the federal government level and at state levels, and that Dangote refinery will have a positive impact on the downstream oil and gas sector. What are those key factors that will factor that shaped the Nigerian economy in 2024? Well, we know the current administration has been focused on some strategic reforms. One of which was a bold move. Of course, some of the unintended consequences have been quite severe on the citizens. Harmonizing the exchange rates, removing the subsidy on petroleum products. These are policies that we had advocated for repeatedly for years. In as much as we think there were some loopholes in the implementation, we still believe they are the policy that should have been taken, though there are some mistakes in the approach to their execution. So we've seen very drastic reforms. We're also seeing reforms in the tax administration in the country, which is supposed to make the tax incentive, make the tax as an instrument to support economic activities and not just as a source of revenue to government. Unfortunately, while that was going on, because of bad politics and bad economics, companies that had made Nigeria their home for years are exiting at a fast rate. I'm sure many of you here would have read that Shell is selling their onshore and Shell offshore assets in Nigeria for $2.4 billion to a group of Nigerian investors called NNPC. In as much as we may celebrate that Nigerian investors are buying up Shell assets, it would have been good if the Nigerian investors were developing their own asset while Shell is also operating parallel to them. The challenge we have is that these are indications that your oil and gas assets are not as attractive to global investors as we thought. And because of that, we're not seeing the kind of capital investment that we need to do in exploration and production that should lead to an uptick or material improvement in crude production. So we must recognize some of these things, and they are not just all celebration. The fact that Shell has left, Mobil has left, Eni has left, all our onshore and offshore assets are also important that they had done their own review. Shell actually decided to leave by 2021 when they felt that the outlook for Nigerian oil and gas sector is bleak, in the sense that you may not in the near future see a material improvement in crude production because of those issues around breach of pipelines, stealing, and other things. But beyond the oil and gas companies, we also saw Unilever, GlaxoSmithKline, Sanofi. You have Equinor, which is also another oil and gas company. You have P&G, and you have Jumeirah Food. You have Jubilee Stranges, which is located in Akwa Ibom. All either have left or have announced they are leaving. So the government, in its drive to attract foreign direct investment, must first of all deal with whatever is driving away these current, those who are already here. Because if, like I've always said colloquially, if you are in a place, if you want to go to a place and everybody there is running, I doubt what we encourage you to head on to that venue, or any location where everybody is running, or people of your like are running away. Then you must be of a different constitution to want to go in there. So government must address that. We think the refinery, Dangote refinery will be a major change, will bring a major change to the Nigerian downstream refining industry. Like I said, you will see a boost in refining, but we also must sign a cautious note that is not a silver bullet that will address all of Nigeria's problems. Our problems are still there. The issues, like I've also said, that the Dangote refinery, unless we have an increase in crude production, it will not lead to stabilization of the exchange rate, because it is what is being exported that is now being given to Dangote. So we need to get to a point where we are producing fresh crude or the incremental crude, which we are giving to Dangote, and we are still exporting our current volume of production. But in terms of domestic supply, I believe the Dangote refinery and Port Harcourt refinery will help us stabilize domestic supply. Another factor that will also help to shape the economy this year is a listing of NNPC. NNPC, the government is working towards listing NNPC Limited on the Nigerian bourse. This will help us deepen and broaden Nigeria's economic landscape. It will also make additional instruments attractive to investors, foreign investors. If in NNPC is further strengthened, it could be a pool to investors to see another class of assets to invest in, or another instrument in the downstream sector to invest in. Of course, this will be an integrator, NNPC, an integrated oil and gas company. There's no integrated oil and gas company that is currently operating listed on the exchange. You have the downstream operator, so you have the upstream operator. Only one upstream operator is listed, which is Seplat. The greatest elephant in the room is the issue of national security architecture. We've seen a consistent and decline in domestic security in the country. We've seen issues of breach of security, kidnapping, cattle rustling, and all sorts of violent criminal activities across the entire length and breadth of the country. If you look at the, I think, Vanguard headline of yesterday or day before yesterday, it talked about the level of insecurity in the country. And they said of the 6 geopolitical zones, only one zone was not affected on Monday, Sunday, and Monday. We are seeing that level of insecurity even coming too close to the seat of power in Abuja. So until that is addressed, a lot of things we're discussing here might be difficult to achieve, particularly in terms of agricultural production. You can't have an increase in agricultural activities if people are still living in an IDP camp. And if you don't have increase in agricultural activity, you won't be able to fight inflation, food inflation. If you can't fight inflation, the standard of living of the citizen could not deteriorate. Then on the banking sector reforms, the central bank governor has made it one of his cardinal objectives to ensure that the banks increase their regulatory capital. But interestingly, that the CBN governor's proclamation or intention to ask banks to increase their share capital is predicated on the economy, that the economy will be worth 1 trillion naira in 2030. That is barely 6 years from now. And but unfortunately, that is not likely going to be achieved. We don't see how the economy become a 1 trillion economy in 2030, 6 years from now. We don't even see that possibility in the next 10 years, 10 years from 2030, if the current growth rate projected by government is sustained. Remember that the government has said in the medium-term expenditure framework that the GDP will grow at 3.76% this year, 4.22% next year, 2025, and 4.78% in 2026. So if the GDP is growing at less than 5%, then, and the current GDP is barely 400 billion, you know how the arithmetic can be worked out at a 5% cumulative growth rate on a 400 billion will become a 1 trillion in 6 years. So the challenge we have is that if the central bank enforce an extremely high share capital of the banks, the banks will be overcapitalized. And therefore, return on investment by those who are investing in the banks will decline. And then it would have been better that those invest because they wouldn't have the investment outlets or the lending outlets without the economy growing and becoming 1 trillion to invest additional capital. So the most appropriate thing at this point is that because if the premise on which the assumption of capitalization is that we're going to be having a 1 trillion economy, then it may just be wiser to channel those additional resources, assuming they're available, to other sectors of the economy that are in their need of funding, and then we'll probably have higher rate of return to investors and better benefit to the economy. Of course, we know that one of the things the central bank governor said is that the reasons for that capital increase is to fund the 1 trillion economy, as well as to help the banks overcome the devaluation effect of Naira harmonization. I guess many of us in this meeting are fully aware of that inflation rate has gone to a 27-year high. The inflation rate for December was closed at 28.92. The inflation rate in December was 28.92, and food inflation is a greater driver of inflation in the country. We've seen consistent increase in inflation rate. We saw a food inflation about 33.93% and the core inflation about 23%. The inflation rate we are facing is driven by items that ordinarily are within our control. Take, for instance, the greatest factor that contributed December inflation was food and non-alcoholic beverages, which increased by almost 15%. And then you had gas and other water and other energy sources, which increased by 4.84%. And then you had transport, which also increased. So first of all, food and non-alcoholic beverages are largely produced here, but it increased by almost 15%, and which is one of the reasons why we saw a food inflation of about 33.9%. Remember that an average household, the basket of consumption average household is more than 50% food. So whatever happened to food inflation has a direct impact on the pulse and average Nigerian citizen, which is why Nigerians are hurting, because more than 50% of their consumption expenditure is on food, and that has seen consistent increase in inflation rates. Okay, now let's look at some of the factors that will drive the economy in the current year, and based on the policy orientation of the current government. Remember that on May 29th, Mr. Asiwaju Bola Ahmed Tinubu was sworn in as the 16th president of Nigeria, and he defined his economic priorities, one of which is that government will engage in budgetary reforms to stimulate growth without causing inflation and reduce import dependency. We're going to interrogate some of this. Of course, this may still be the early days to interrogate them, but in terms of budgetary allocation for 2023-2024, it doesn't look like the first point was high-stepped, because we had a budget deficit of about 9.1 trillion naira, which is inflationary in nature. And then the budgetary reforms don't seem to have taken place. The government intends to promote domestic manufacturing and address multiple taxation. I must commend the government it relates to the issue of multiple taxation. The Taiwo Oyelade's committee has been doing a great job in terms of harmonizing the tax system and eliminating multiple taxation. We hope that the other priority areas of the government will also be tackled with the same level of velocity that is currently going on in tax reforms, particularly as it relates to domestic manufacturing. We saw that sector grew at only 0.4% in third quarter of last year. The government said they want to focus on power generation and transmission, as well as distribution. I understand there are about 6 licenses were issued recently, announced by the Nigerian Electricity Regulatory Commission. But we've not seen any material improvement in power generation, and we don't seem to be hearing policy pronouncements that will give assurance that something is being done to address the power supply issue. But these are among the priorities of government. Like I said, this may still be early days to begin to pass judgment on these issues. Security, the government said, is going to be one of its top priorities, and it's going to reform the Nigerian security architecture, which will involve investing more in security personnel, providing better training, equipment, pay, and firepower. Once again, I can only say that you see maybe early morning when it comes to appraising how that has happened, but so far we're witnessing heightened level of insecurity in the country. I think today people in Abuja will be protesting against the rate of kidnapping in the country, in the federal capital territory. In December, I think on the eve of Christmas, over 100 were killed in Plateau. I'm not aware that people have been apprehended on that, over that. Several people were killed last weekend in the Zamfara, in Katsina, in virtually every way. So, but we are hopeful that we are praying. We are praying, but we tell you prayer is not a strategy. Something the government will keep to its commitment. But in terms of policy pronouncement, these are issues that are very germane to economic recovery, job creation. The government said it's going to set up an omnibus job and prosperity bill, saying an omnibus job and prosperity bill to the National Assembly. We're waiting for that. The bill will aim to facilitate labor-intensive infrastructure improvement and encourage light industry and enhance social service for vulnerable people. We hope that some of these things are not statements that are supposed to make us sweeten our belly, like we say in Nigerian palace, make us feel happy, but we hope that there will be a fully implemented infrastructure. Unfortunately, until we address the issue of the budgetary reforms, infrastructure being a priority of the government will still not be achieved from budgetary allocation. I'll give you a classical example. In the first 9 months of last year, the federal government spent 8.65 trillion naira. Of that amount, only 1.4 trillion naira went into capital expenditure. Fuel subsidy, the government has been very bold and courageous with this. They've taken out a subsidy, though because of recent devaluation, we may have witnessed keeping back of subsidy on refined petroleum products. But nevertheless, clearly, the government took a very bold step in taking out subsidy on petroleum products. Agriculture will also depend on a couple of factors. The government said it wants to take measures to secure rural income, including commodity exchange boards, to guarantee minimal prices for crops and animal products. We think the priorities at this point, given where we're coming from, should be to improve agricultural production by arresting the spread of insecurity in major of the food base of the country. Monetary policy, we must also commend the government. We are commending the government on 2 areas. One is first subsidy removal. Like I said, these are policies that were absolutely necessary. The implementation may not have been top range, but there are policies that had to be taken one way or the other. So we've seen a harmonization of exchanges. Yes, we may have seen divergence, but we believe that in the current year, the Monetary Policy Committee will push to see harmonization. And hopefully, if there's an improvement in supply, we will have some level of stability. But that will depend. Improvement in supply will depend a lot on ability of the government to increase crude oil production. Yeah, last third quarter of this year, where we saw a surplus trade balance, a positive trade balance, which has happened in the past 3 quarters, which also means that ordinarily we should see an accretion in our reserve if you have a surplus trade balance. Unfortunately, because we have a huge arrears of payment due for foreign exchange like obligations. We have the futures, the forward transactions, which the Minister of Finance said is about $6 billion. We have amounts due to the airlines. We also have swap that was entered between the central bank and local banks. These factors are making it difficult for us to see an creation in reserve as a result of positive balance of trade. And unfortunately, the second thing that should have also helped us stabilize the exchange rate is capital importation. It was hoped that when the government harmonized the exchange rate and removed subsidy, that people were saying that investors will begin to scramble for Nigerian instruments. And some of us said, look, until you address the issue of arrears of unmet demand, that you are not going to see investors come into the market. And that was reflected in the capital importation report, if you look at the capital importation report for last year, the third quarter of last year, you will observe that the capital importation actually declined. We'll get back to that. Okay, I'll show that. I hope I have that slide here. That the capital importation declined to about yeah, we have the slide, about $654.65 million from $1.030 billion. So we are hopeful that because of limited constraint, low consumer purchasing power, that demand for imports will continue to moderate. Hopefully with Dangote refinery, depending on whatever fiscal arrangement the government has entered into with them, we may see a reduction in our imports for refined products. Hopefully, that will not be knocked off by reduction in exports, which may end up with the same balance of trade. But if the export is sustained, that means if crude production improves, we should see a material improvement in a balance of trade. Now going to some of the instruments that the government has to use to drive economic activities in the current year. We've seen the government make a budget provision of 28.77 trillion naira. This is premised on a couple of assumptions. One is that crude production will be 1.78 million barrels a day. Exchange rate will be 800 naira to $1, and crude price will be 77.96 dollars per barrel. So the key challenge is that based on this, the government had projected a revenue of 19.59 trillion naira. The member had said earlier that the first 9 months of last year, total government revenue was only 8.65 trillion naira. So even if you use that amount to project another quarter ending, which should give you another less than 3 trillion naira. If you add 3 trillion naira or 2.5 trillion naira to 8.65 trillion, you are going to add up with something like 11 trillion naira, which would have been the best the country would have earned last year. So from 11 trillion naira expected revenue for last year, you now want to leapfrog to almost 20 trillion naira. We think that's quite optimistic. We think the projected crude production of 1.78 million barrels a day is optimistic. First 9 months of last year, crude production was averaged about 1.33 million barrels a day. In October, it was 1.25 million barrels a day, down from about 1.35 million barrels a day. And the challenge you have is that if the budgetary revenue is, government has already budgeted about 9.1 trillion as deficit. So if the budgeted revenue is not achieved, then the capital budget of about 9.9 trillion will be difficult to achieve. In the first place, even if the budgetary revenue is achieved, virtually every kobo that will be spent on capital budget will be borrowed. And that's why some of us have said that clearly it will be impossible for the government to sustain infrastructure development from budgetary allocation unless we pivot away from that approach. I had mentioned the issue of debt, which has continued to rise. We've seen our debt at 87.9 trillion now, and we know that if you add the amount that the federal government securitized in December of 7.3 trillion naira, you'll be talking of a debt of about 95 trillion naira. Yeah, they'll tell you that our debt to GDP ratio is still around 40-something%. But the problem is that debt service to revenue is approaching 80%. And that's where the problem is. Oil production, I had mentioned that oil production in November was 1.25 million barrels a day, down from 1.35 million barrels a day. And the fact that the oil majors are exiting your onshore assets, and they have a deeper pocket in terms of exploration and production. Yes, they've analysis, but you still have to get funding, and you're also inheriting those issues that made them run away, which is the issue of pipeline breaches. So there's no guarantee that crude production will materially improve in the current year. Added to that is that OPEC Plus has begun to shake, efforts by them to reduce crude production so as to help stabilize, sustain crude prices above $80 seem to have failed. We've seen crude trade around $78 per barrel, which is even below about the rate that Nigerian government has earmarked as benchmark. So even Angola, your sister African country, has exited OPEC, and you don't rule out the possibility that if OPEC try to enforce further cut in production, those who depend on crude or are not major players may exceed OPEC, and that will create some level of distortion in the market. So this is an indication of the recount, which also should measure crude production. The recount in December, it was 16. So hopefully that increase in recount to manifest in higher level of crude production, which will also reflect in our foreign exchange earnings. External reserve, talking about external reserve is actually a very interesting thing, because what we talk about is the gross reserve. Nobody has come out to announce effectively the net reserve. JP Morgan tried to do that and created some level of upheaval in the economy. But the basic thing I said earlier is that we should have expected that the positive balance of trade should lead to an increase in our foreign exchange reserve. But because of arrears of unmade obligations we have to clear, that has not manifested in the reserve. So exchange rate will harmonize. I've talked about that last year, and then that was on June 14th, and then we've seen a wide fluctuation in the exchange rate. We saw the NFX window close at 907, and the parallel market closed at 1,200 last year. So this is just to give you an idea of the movement in exchange rates. Bonnet Light was $79 last week, and I know that it had gone down below $77 at some point, but moved up when the flash the issues around the Red Sea occurred. So this is what I was going to, that we would have ordinarily expected that the short-term capital flow will help us tidy through when there's a shortfall in export earnings. But unfortunately, we've seen a material decline, constant decline now, capital importation, which also means that even the policies that we are taking to harmonize the exchange rate have not been viewed positively. Well, even if it was viewed positively, but because of other limiting factors, which were unmet demand, instability in exchange rates, and low reserve, foreign portfolio investors are still sharing away from the economy. At the end of the first 9 months of last year, only $2.8 billion came into the country. Compare that to 2022, where $5.3 billion came in. 2021 was $6.7 billion, and 2020 was $9.6 billion. So if you look at that from 2019, you would realize that it looks like foreign investors are sharing away, consistently reducing their vote to the Nigerian economy. The equity market has spoken about that. We saw an all-share index growth of, I'll quickly round up so that people can take questions, growth by 45.9%. I had said earlier that in the current year, we've seen the market gain as high as 17.65% as at the close of work trade yesterday. So the major gainers, you have the sectorial performance last year. Then if you look at, this is to show you the individual stock that gained most last year. You saw Transcorp gained 1,023%. You saw Chams gain 79%, Computer Warehouse at 722%, Transcorp at 666%, MRS at 645%, and on to FTN Cocoa at 410%. And on the right side, you see the laggards or the losers: Royal Exchange, Julie Champion, Ella Lex, Farmadeco, Nigerian Breweries. These are the laggards. And then, as at close of work yesterday, as the last trading hour, these are the major gainers so far in the year, which accounted for the 17.65%. You've seen Guinea Insurance gain at 6%, almost 100%. You've seen TIP gain at 3%. You've seen Wema Bank at 89%. You've seen Jais Bank at 88%. Linkage Assurance at 18%. Transcorp at 84%. Unity Bank at 84%. Sterling and Simpsons and what have you. And then you see the laggards here. So what do we think? We think we are trying to do this to see, is there any pattern? Because we think there may be some hot air in the stock pricing today. And we try to see the trend has happened in the past. And if you look at this graph, you will see that whenever there's a disconnect between the GDP performance and equity market performance, the next year there's some correction. In 2013, the market gained 47.19%. The GDP for that year was 5.4%. The following year, 2024, there was a correction. The GDP grew at 6.22%, but the market went down by 16%. And in 2017, again, we saw a spike where coming from a recessionary year, the GDP grew at 0.82%, but the market gained 42%. The next year, which was 2018, though the market economy grew slightly faster at 1.92%, the market corrected with a decline of 17%. We've seen that again. We saw that again in 2020. The economy was in recession. In 2020, the market gained 50%. The following year, the economy recovered by 3.4%, but the market gained. It didn't go into a recession. It didn't go into a contraction and a decline, but the market growth slowed down to 6.6%. In the current year, we think there might be some correction and the market performance may slow down, but it depends on a lot of factors, which I'm going to talk to us as we gradually round up. So what are the macroeconomic outlook? On interest rate, the direction of interest rate in 2024 will depend on the following factors: effort by CBN to slow down inflation, ability of the federal government to absorb higher interest costs on its domestic loan portfolio. Remember that whenever the central bank increases interest rate on government debt instruments, the federal government has to pay higher interest. So it is federal government's interest that rates are kept artificially low, so that we are subsidizing the federal government, and then its interest costs will be lower. Then effect of efforts to attract foreign portfolio investors. We think it will be wrong-headed if the government should, as their priority, focus on attracting foreign portfolio investors until we clear the arrears of unmet demand in the FS market. That's when foreign portfolio investors will now begin to come in. Then the level of liquidity injection by ways and means. So if the federal government borrows more from the central bank will compel to suck up that liquidity or take out that liquidity by increasing rates. These are factors that will drive interest rate this year. On inflation, we think inflationary pressure is likely going to continue. One, we need to address the issue of food production for you to cut down on inflation. Two, the pass-through effect of a further depreciation of local currency will reflect on inflation. And three, the government likely going to borrow more by way of ways and means. So if government borrows more by ways and means, that will lead to liquidity suffix coming into the economy. And then fourthly, the government plans to, the government fiscal plan is expansionary in nature, which means the total expenditure will be higher than the total revenue, which is one factor that will lead to inflationary pressure. Remember, the government also wants to increase salaries of government workers, and any increase in salaries of government workers will lead to higher level of liquidity, and that will affect level of money supply in the country, and therefore higher level of high inflation. So we think inflation will remain strong, in as much as we project that it will moderate because of the base effect. But I've spoken on our own optimistic, moderate, and pessimistic outlook as it relates to inflation rate. On exchange rate, we think Naira will suffer additional depreciation of the currency, which is why we say our most optimistic, most realistic is about 1,300 Naira to $1, and our pessimistic is about $1,500 Naira to $1. We think unless we have a material improvement in crude production, the supply of crude going to Dangote will reduce the amount of foreign exchange earning from sale of crude. And that means we are back to the same position when it comes to net FX inflow. And as long as we don't have enough money to clear the arrears from our trade activities, not from borrowing, unless we can borrow long term. Yes, borrowing to close arrears is important. It's a good way to go, but we must make sure the borrowing is longer term in nature and not necessarily tied to crude swap. Because once you do a crude swap, and unless a swap is going to be deferred, if the crude swap becomes immediate, it simply means your subsequent cash flows are already taken up front. So you really it won't solve the problem. But we advocate for borrowing to clear the arrears, but the borrowing must be structured and payment will start in years to come, not immediate. On the market outlook, the equity market had gained 45%. I had said that in the first few days of this year, we've seen a market gain 17.65%. So we expect that some level of adjustment in exchange in prices will happen this year. We think some of stocks are currently overvalued beyond the intrinsic value. And then the other factor would be if the central bank begins to increase rates on fixed income instruments, it could lead to portfolio investors underweighting their portfolios in equity and overweighting it in fixed income. Then another factor is a flight to dollar by HNIs, like high net worth individuals. If HNIs think Naira will come under additional pressure, they may want to sell their local currency assets and take Naira position. So we advise investors to focus on value stocks and avoid the head syndrome. Sectors with relative strong products include the banking sector, the industrial goods sector, the construction industry, and the oil and gas sector. Money market outlook. Central bank has been consistent interest rates in the last few auctions. We saw a stop rate of 12.24% for treasury bills in the auction of 10th of January. And then, and conversely, we saw a 17.75% stop rate for OMO The OMO rate is actually designed to attract investors because local investors can't buy OMO unless they are banks. So, but our take is that in the near future, as we move towards the year, the monetary authorities had actually said they want to use monetary tools to fight inflation. They will have to adjust their approach and be consistent in creating an environment of higher interest rates that will help slow down inflation, but most importantly, lead to a positive real return on investment. In the fixed income market, we think the central bank's declaration that they want to maintain price stability will be a major factor. It has not reflected in its current practices so far, but we think in the coming second quarter, they will be forced to adjust a return on fixed income instruments to be in tandem with inflation environment. In the Eurobond market, we think the primary market will be very tight. So federal government's intention to borrow from the international financial market will be difficult this year, principally because we are seeing countries in similar financial conditions as Nigeria defaulting. Even if Nigeria is slightly better than them, but investors will be pricing that into whatever yield they expect from a country like Nigeria. So we think yield on for Western countries issued Eurobonds, either corporate or sovereign, will moderate further as the economy stabilizes and inflation rate drop in those countries. But for emerging markets and developing economies, we see a further increase in the yields on their Eurobond instruments and a decline in their prices. The foreign exchange market, we think the federal government, the central bank will struggle to meet areas of demand in the immediate. Hopefully, if it adopts a long-term borrowing approach to use that to clear, if it takes short-term money like we did from Afrexim, and then he has to start paying it back immediately, it becomes a difficult thing because that will further strain current cash flow and create additional gaps. But if it borrows long-term, then it should be able to use it to close the areas and help stabilize the exchange rate. But in any case, we think unless crude production improves, or the federal government borrows long-term to close the areas, we should expect a further depreciation in the current year. On Main Street, I said, I'm going to leave this for questions that people want me to speak on their sectors. I had mentioned personally the construction industry. I think that will be a beneficiary of government expenditure. I think the manufacturing sector will still have to face two or three challenges: possibly high cost of borrowing. The federal government has suspended most of the intervention funds because they say they want to use autonomous monetary tools. They have to still struggle with sourcing effects for their raw materials. And then the market demand, consumer demand has weakened. So that may affect manufacturing. But for those who are manufacturing low-value items, they should expect a stronger demand from consumers because federal government is going to increase salaries of government employees. Because of the impact of that increase, demand will be largely for local items produced locally, but local items of low value, not expensive items. On the construction, on the real estate industry, we think high-end properties will be only bought by largely people who are involved in politics or process of criminal engagement. We're already beginning to see that from reports we heard about the suspended minister. But emphasis should be for those who are into real estate development on medium income development or medium cost developments, where the funding can be from corporate employees or employees in corporate entities from their earnings. In terms on the entertainment industry, I think that sector will continue to grow. Is largely prepared by one, advancement in technological availability and usage, and we think that sector will grow and become a major contributor to the economy. On the fashion industry, I think local fashion producers should benefit because of high exchange rates. So you are going to see a lot more people focusing on consumption of locally made fabrics as well as fashion design, local fashion designers. Like I said, the Main Street is inexhaustible. I will stop here and then I can take questions. Thank you and remain blessed. This is about Cowry Asset, the company that is making the benefit to you. So I can take questions. Miracle, are you there?
Yes, I am, sir.
Okay.
Thank you so much, sir, for that insightful session. We are grateful to have you, and I'm sure everyone on this call is also grateful to have you. So there are some questions raised, and I would love to share that with you so we could get your insights on that. So Mr. Ahmed Musa is asking that agriculture, from this slide, we saw that agriculture contributed the highest in GDP for year 2023. So he's asking, what has with food inflation, he said food inflation keeps increasing in the market on a daily basis. That what's our take on that with food inflation at 33% high? Should I read out all the questions, then you take it?
No, I can take them as you asked. Okay. For Ahmed Musa, the basic thing is that agriculture production, the additional value of goods and agricultural produce produced in the third quarter of last year grew by only 1.3%. Remember, our population is growing at about 2.4%. So the number of mouths that are being born to eat the food is increasing at a rate higher than the additional food being produced. And then, not only that, a number of people who used to produce food are now in IDP camp. So if they are supposed to go, if they're back in their homes, they may be able to produce more food than the number of people who are added to eat the food. And again, because of devaluation of the local currency, people who used to eat foreign-made food have all pivoted back to eating locally made food. So the demand for local made food is higher. And that's why if you look at the factor, the item that affected food inflation, like things like tuber, cereals, and when they talk about tuber, they're kind of yam, potato, cassava, and what have you. And these things are produced locally. They're talking of rice, they're talking of meat. And the meat we eat here are produced here, the rice, the fish we eat here are produced here. They're talking of egg, they are produced here, but we're not producing enough. The increase that we're producing is not as much as the number of people who are coming to eat it. So that's why, while agricultural sector grew by 1.3%, the population is growing about 2.4%.
Okay, thank you so much, sir, for that. Mr. Ahmed Musa is also asking that with the move by the new CBN governor for the bank recapitalization, how would that improve the Nigerian economy?
I think I spoke on that, and my take is that it's strongly timed in the sense that the premise, there's what they call fallacious statement, and that's a statement based on false premise. The false premise does not mean the person who is making the premise is lying, but is based on false assumption. The recapitalization plan is based on a projected $1 trillion economy. The economy is barely $400 million today. If we are growing at 5%, where the projection that we will grow at 3.7% this year, 4.22% next year, and 4.78% in 2 years' time. So by the time you are 2 years' time, which is 2016, 2026, you only have 2 more years, two full more years to get to beginning of 2030. So at that rate, your economy will still be in the region of 450 by the time you get to 450, 470 by the time you get to 2030. So if you ask banks to now bring capital, what for $1 trillion economy, then who would they lend to? Because the economy has not expanded. The people who should only come to borrow more are not there. So in effect, it won't have a solitary effect on the economy because the banks will be overcapitalized. They can't start knocking on your door and say, come and take money when you are not even in existence. So And my recommendation is we can as well channel these additional resources if they are available to other sectors of the economy that are begging for funding. For instance, if you put those monies in infrastructure development, and then you can actually evolve a private-public partnership where private sector investors can invest in infrastructure, and you have infrastructure fund and infrastructure bond, and those monies go into infrastructure fund and infrastructure bond, and they fund infrastructure. We're going to have a more pronounced effect on the economy and even on employment than just giving the money to the banks.
Okay, thank you very much, sir. There's a question here that says, how do we stabilize the forex market? And okay, let me just merge it with this other question because someone else is asking how we can attain price stability in our economy. Can you merge these two?
Okay, how do we stabilize the exchange and achieve price stability? Let's start from stabilizing the exchange. I had mentioned in the presentation that, look, for us to stabilize the exchange, we need to increase crude production. That's the shortest route for Nigeria to stabilize the exchange rate. The other routes are going to be tortuous in the sense that they are partly outside our control. But crude production is produced here. It depends on our ability to resolve the issues around Niger Delta and make them have a feeling that the benefits accruable from crude production also accrues to them. There's already what the government has come up with, what they call host community fund. And the host community fund is supposed to be used to intervene in those local communities where crude is produced or oil and gas is produced. So that is the shortest route to stabilizing the exchange rate. It is when the exchange rate is stabilized, you're going to have price stability. As long as Naira is depreciating on a daily basis, the pass-through effect of Naira depreciation would mean a further increase in price levels. Two, unless we produce more food, if more people are locating to the IDP camp, we are producing lesser food, then price, they tell that the definition of layman definition of inflation is when more money is pursuing fewer goods or few goods. So it simply means more mouth to be pursuing the little food that is being produced, and those will lead to the increase in the price of those food items. That's the second factor. The third factor is the issue around the government borrowing money from central bank is not backed by productive activities, what they call ways and means funding. So if we eliminate these three factors, address these three factors, we're going to see price stability as it relates to consumer prices.
Okay, sir. Mr. Ogundapo here is concerned with the stock market, and he's asking, with the current high prices on the NGX at the moment, would the dividend-paying securities be able to sustain their dividend yield?
I think I spoke on the fact that we think that the current prices and even the gain we've seen this year may imply that some stocks may be overvalued, not all. So, and that will reflect on their dividend yield, their earnings yield, their price earnings ratio. It's and which is why one of the things we advocate that you really can't go blindly to go and invest. And in my report, I said you need to avoid the head syndrome. So I expect investors in the capital market to approach institutions like Cowrie to guide you in what you want to invest in. Otherwise, there's a risk that you could be investing in a hot air because clearly there's some prices are elevated. We will do this analysis and assure you and give you the confidence that, look, if you invest in this stock at the current prices, this is the kind of yield you should expect. We have also gone as far as mentioning some sectors, not that every instrument in those sectors is properly valued, but some sector that may still both strong growth potential.
Thank you, sir. There's a question here that says, do you think Nigeria should follow suit with Angola exiting OPEC?
I don't think so. Nigeria has some other filial relationship with OPEC members. Nigeria is a member of the Islamic Organization of Islamic countries. Most OPEC members are members of Organization of Islamic countries. Angola is not. So there are some other relationship that Nigeria has that may be difficult for us to severe. Nigeria has a lot of, Saudi Arabia has a lot of influence on Nigeria, and Saudi Arabia is basically the major driver of OPEC. So I don't think, for other reasons, I don't think Nigeria should exit OPEC. What I think Nigeria is we should have a strong bargaining power in OPEC. But the problem we have is now even our crude production allocation, our crude production allocation by OPEC and OPEC Plus. The problem is that we're not even producing enough crude to meet our crude allocation. So you have to first produce enough before you go and ask for an increase in your allocation. And Nigeria is not in a position to complain. We need to deal with the issue that are internal to us before we even talk of OPEC allowing us to produce, giving us more latitude to supply more to the market.
This question is also in line with the oil and gas sector. Someone is asking that you mentioned that there's only one upstream oil and gas company listed on the NGX, which is Seplat. He's asking for clarity because he was of the opinion that Owando was also listed on that exchange and is also a player in the upstream sector.
Owando has applied to delist its upstream business from the oil and from the Nigerian bourse. So we can no longer count them as listed on the exchange. As it stands today, we can only say that Seplat is the one listed. You know, one of the things that Owando did was they restructured and took out the upstream business out of the Owando and then took it private.
Yes, sir. Then I think this should be the last question from the oil and gas sector. Someone is asking that would the price of the locally refined Dangote fuel be cheaper than the imported fuel?
That would be a tough call in the sense that Dangote is getting the product, unless if the Nigerian government decides to subsidize the crude going to Dangote. And remember, the Nigerian government has only 55% of crude share from onshore and scheduled offshore assets. At the deep offshore asset, the fiscal arrangement is actually lower than that. So part of the crude going to Dangote is beyond what they call the domestic crude obligation. So for that reason, Dangote will price the crude is buying at international crude price. If it does that, then it will sell at international crude prices. The benefit we'll get could be that the cost of shipping will be reduced. The insurance that is involved in shipping will be reduced. The lead time it takes to take product from Antwerp to offshore Benin Republic will also be reduced. So there'll be some operational cost savings, but it may not be as material as most people have been expecting.
Okay. Mr. Adeyemi is asking, what is the effect of the Ministry of Finance taking ownership of the distribution companies? Will it result to efficiency in distribution?
It will not necessarily result in efficiency in distribution. The problem with the distribution company is that they've not achieved, the power sector has not achieved what we call commercial viability. The distribution company do not have money to invest to reduce the aggregate collection and technical collection and aggregate technical collection and commercial losses, ATC and C. And the Ministry of Finance will not have the money to give to them. The government has actually given them so much money. As it stands today, we need to review the ownership structure of the downstream power sector, which is the distribution companies. Because if they did not invest in transformers, if they did not invest in smart metering, then they can reduce the aggregate technical collection and commercial losses. If they're not unable to reduce that, because of the losses, they will not be commercially viable. And so it's the change in who holds the shares on behalf of the federal government. It was BP that was holding the shares on behalf of the federal government. The change in who holds the shares, the federal government shares, does not necessarily imply change of management of the distribution company, which most of them have been changed because BP had actually intervened to withdraw the licenses from the original licensees. But now that subsector requires funding and transformational management.
Lastly, I know I said last for the oil and gas, but there's one more question. Someone is asking, Mr. Tochukwu is asking that with the establishment of Dangote refinery, can we anticipate a rise in the share price of oil and gas companies listed on the exchange?
Well, that's a very strong, a very tenuous nexus to establish. The fortune of a company depends on its turnover and profitability. Okay, and we need to see whether a Dangote refinery will mean that an Etana has more product supply and can increase your volume of sales and increase your profit margin. So if that does not lead to it, we are even yet to see the distribution channel Dangote refinery will adopt, whether they will, it will still be the same distribution channel we have today, where major oil companies who have depot buy products from mostly AGO from international oil companies and distribute through their stations and other traders. Also, we bear in mind that all 99% of fuel import today is done by NNPC because of the subsidy I had mentioned earlier that had crept back into the system. So if we have to maintain a subsidy, which I have also mentioned that I expect will allow for further movement in refined petroleum price, which means pump price of petrol will be adjusted this year. Note this statement, will be adjusted upward this year to eliminate the subsidy. If that is not done, then it simply means NNPC will import this product from Dangote and then distribute through the local oil trading companies. And that means the situation we have today will remain. And that you may not necessarily see a material change in the turnover of those companies or their profitability.
I think this should be the last we can take for now. Someone is asking, do you see Nigeria approaching the IMF in the near future in terms of for loan or capital importation? And what's your outlook for capital importation and what can be done to improve it?
Okay, Nigeria approaching IMF, I thought that should have been done much earlier than now, but since it has not been done, I can't read it out because our situation still remains precarious. The 3.3 trillion we're getting from Afrexim is a drop in the ocean given our demand. The solution to our problem I keep emphasizing is our ability to improve crude production. So we can't read it out, but like I also said, the more we accumulate debt, the more precarious our fiscal and financial situation becomes. And I pray we don't get to a point where we become like a Ghana that had to default. We are far from there, but if we continue in the same trajectory, we will get there. So approaching IMF is not out of place. But it all depends on how we manage our finances.
Lastly, what is the effect of the 100 billion for consumer credits in the 2024 budget? What does this effect have on inflation, sir?
Well, in the first place, when you have 100 billion for consumer credit, the question you have, how do you want to disburse that? Are you going to go through the conventional banks? Are the banks going to guarantee it? And when you talk about consumer credit, you're also talking about income. The people who get consumer credit also must have the income to pay back. Ordinarily, if you have a strong income, per capita income in the country, a consumer credit of 100 billion will stimulate consumption because the borrowers will have the capacity to pay back. But what stimulates consumption will also stimulate production. And when production is stimulated, it also stimulates factor input demand, which means it stimulate demand for raw material, to stimulate demand for additional employment. So, and that's how you can trigger the wheel of economic activity or economic growth. But with low per capita income, then you have to deal with how do you disburse a consumer credit to a population that is impoverished. So I think the starting point is increasing salaries of government employees. And that way, that it will give them more resources, financial resources to come to the market and consume.
Thank you very much, sir. I think this is the this is what we can take at this moment. But if you have more questions, our email address is listed out here, info@cowryasset.com. Please feel free to send your questions and we'll answer as soon as they come in. Thank you very much to everyone who took our time to participate. So a little bit more about us before I give our Senior Vice President who will be taking the vote of thanks. We are Cowry Asset Management Limited. We are a financial boutique. We carry out activities such as stock trading, financial consultancy, a lot of things anyway, but basically we are open. We have 3 branches. Our head office is in Lagos, and thank you once again for having us. Thank you very much, sir, for your time. So Mr. Opudili, please join the call to give the vote of thanks. Thank you.
Okay, thank you, our GMD, Mr. Johnson Chukwu, for a beautiful delivery today. And we appreciate everyone who has created our time to be with us today. We have spent almost 2 hours on this section of the webinar, and it has been very insightful. We hope you've been enriched with enough knowledge to guide your investment decisions. We don't want to waste most of your time. Like Miracle said, we are available to entertain more of your questions. So if you have needs or inquiries concerning investment and finance, please feel free to reach us. We'll be able to create value and make sure you invest intelligently. Once again, thank you. We'll be doing this again in the next quarter, first week of April. We'll do another webinar that will also be anchored by our Group Managing Director, Mr. Joseph Chukwu. Thank you and God bless.
Thank you, everyone, once again. And we'll see you again at the end of the first quarter of this year.